Hi everyone, thanks for joining us today. I'm Louis Baca, host of Bacast. I have a very familiar face. You've seen him before, Chris Handy. A lot of news and a lot of media has talked about the forbearance option. Now, it's a last resort for a lot of people that are struggling to make their payments. The mortgage payment is a very large portion of your budget each month. So I brought Chris on so we could discuss this in a little bit more detail. Chris, back in October, wasn't it you and I were sitting out in Scottsdale, Arizona, talking about how the recession was coming?
About there as indicators, very well could be there's an oncoming recession. Very well could be losses in the stock market coming up in the next year or two or whenever. If that happens, what we're teaching folks to do is to set up a standby credit line on their home equity. Now, the idea isn't to take money out of home equity and invest in the stock market. The idea is to give folks a place that they can take their retirement withdrawals from that they're normally taking out of their portfolio, switch it over to home equity, give the market a chance to recover once it starts falling, and then switch it back over to their retirement plan once the market has started to recover.
Now, at that time, we didn't know what was happening, what would cause it, right? The economy was on a strong footing at this point when the COVID-19 hit. Granted, we were in this tremendously long stretch of economic, progress and expansion, one of the longest expansion periods in U.S. history. Here it is. We're facing head-on a recession.
It's not a new idea, but now is the time where it's really, I see people running out to apply it now.
And I think there's a third benefit that, besides being able to shift over your expense, your income to cover your expenses, besides being able to insulate yourself with kind of like a, I don't want to say permanent forbearance, but the ability to not have to make a mortgage payment, which is huge, right? And then the third thing here is that you're insuring your equity, because we are expecting a drop from this. If people lose their job and they don't have any other alternative, that they have to sell their house to liquidate their assets, then home sales are probably going to drop. It'll cause home values to drop a little bit. So if that happens, the reverse mortgage ensures through the federal government, right, Chris, that their home value, even if it goes down, their credit line still stays there, correct?
Yeah, the reverse mortgage is unique in that most of these are set up as credit lines. Most reverse mortgages are. So it's a credit line that you can pay on the balance of the credit line, or you can not pay on it, or you can draw funds out of what you're eligible to draw and pay those funds back when you feel like it. But the portion of the credit line that you don't use, in other words, the portion of your credit limit that is available beyond what your mortgage balance would be, that portion grows, and it grows at whatever the interest rate is. So plus an additional 0.5%. So if your interest rate on a reverse mortgage, and right now they're floating around 3%. It's a good deal to have a reverse mortgage right now, just once per year. And going back to 2005, the average is around 3.5% to 4%. But you get growth on the credit line based on that interest rate. So interest rate's 3%, add a half, you get a 3.5% growth on your credit line, and you get 3.5% growth on anything that you pay on the reverse mortgage. You pay $1,000 into the reverse mortgage, that increases the credit line by 1,000, and then that 1,000 also grows at 3.5%. So it's a pretty good deal when you think about it.
You're kind of getting almost a guaranteed return, right? Versus the uncertainty of the markets right now. People that thought they had a pretty good, guarantee there have quickly experienced that that's not necessarily the case all the time. So if you can get the guarantee, it's better to shift your weight that way, right?
Yeah. The federal mortgage insurance protects the credit line so that it can never be shut down, and it will always get that growth rate that it's guaranteed to get. And so therefore it's a pretty safe place to park money against your balance. Now you can't I've had this question come up. You can't park more money than what you owe in the reverse mortgage, but let's say somebody has a regular mortgage of 125,000 and their home is worth 300,000 or 400,000. You could actually move additional money outside of the home equity up to 125,000 into the reverse mortgage, and that whole amount will grow at, right now 3.5%, 4%, depending on what the interest rate market's doing.
Wow. Yeah, that's a good thought process, right? A lot of people have access to their 401k right now. They're probably feeling pretty vulnerable with it. You can pull out $100,000 of your 401k penalty free. Have you heard any more guidelines? Would that be a smart move for them to do that?
Most people that I do a reverse mortgage for will qualify on what their Social Security is alone. So if they're drawing Social Security, most folks are, that alone will qualify for them for a reverse mortgage. So we don't have as onerous of income qualification barriers as you do on a regular forward mortgage. And it just goes to the fact that it's because if you have enough equity for this, it's assumed you don't have to make any payments, right? So you have to have some income to verify you'll be able to continue to pay property tax installments. You'll continue to maintain homeowners insurance on the property. So that's why there's income qualification at all on there. But it's not nearly as strict or as onerous as regular mortgage qualification. So it's easier to qualify for a reverse mortgage, assuming you have the equity to do it. And the equity to do it is based on age. I would say a 62-year-old needs right somewhere around 50%. A 75-year-old might only need 40-45% equity to do it. So we kind of do an analysis and see where people fall and take a look at what the loan balance ratio is to the home property, the loan to value, and then determine what their qualification amount is from there based on their age and current interest rates. Now, current interest rates are bottoming out as far as qualification is concerned. So now is a great time to do a reverse mortgage because home values are still holding their own or possibly at a peak. But interest rates are near the floor too, as far as qualifying for more money. So if you're ever going to maximize the loan to value that you get out of a reverse mortgage credit line, now is the time to do it and look into it.